Even with the best strategy in the world, if you don't understand market structure, you will keep losing, because trading is not about predicting the market. It's about understanding who is in control, buyers or sellers, and aligning your trades with them. In this lesson, you will learn how to identify market structure and how to use it to make better trading decisions. Now, let me show you exactly what you will learn in this video. In this video, you will learn how to identify trending market structures, how to understand buyer behavior during uptrending markets, how to identify range-bound markets, how to trade each market condition correctly, the Wyckoff market structure phases, how to apply the TLS trading method, how to combine market structure with support and resistance, how to use candlestick patterns to confirm your entries. Before we get started, if you enjoy this type of content, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss any future uploads. Now let's get started. What is market structure? Market structure is simply how price moves, nothing more. It's the way the market forms highs and lows. Look at any chart. Price is always doing one of three things: going up, going down, or moving sideways. And as it moves, it creates a sequence of highs and lows. Market structure helps us understand who is in control of the market, whether it is buyers or sellers. And based on this information, we can plan our trades in a more logical and professional way, instead of guessing where the market might go. When the market is moving up, it starts forming what we call higher highs and higher lows. This type of movement is known as an uptrend, and it clearly shows that buyers are in control of the market. However, it is very important to understand that an uptrend does not move in a straight line. The market does not go up continuously without stopping. Instead, it moves in a repetitive cycle. First, we have a move upward, where buyers are actively pushing the price higher. This move is called the impulsive move. It reflects strength in the market, because buyers are dominating sellers and driving the price up. Then, after this move, the market does not continue going up immediately. Instead, it starts to move down slightly. This happens because some buyers begin to take profits. As they close their positions, the price temporarily pulls back. This movement is called a pullback, or a retracement. So in an uptrend, the market is constantly alternating between these two phases, an impulsive move upward followed by a pullback. Now let's look at a chart to understand this better. Here, you can clearly see the first move upward. This is the impulsive move, where buyers are pushing the market higher. After that, the market starts to move down slightly. This is not a reversal, but simply a pullback caused by profit taking. Once this pullback is completed, the market prepares for the next move upward. This is where many traders make mistakes. The most important question now is, how do we trade this structure? The correct approach is not to enter randomly and not to trade against the trend during the pullback. Instead, we wait patiently for the beginning of the next impulsive move, because this is where the highest probability opportunities appear. Let's look at another example. As you can see, the market is trending upward. It makes a strong move up, followed by a pullback. Then it moves up again, followed by another pullback. This pattern keeps repeating itself. If you do not understand that these downward moves are simply retracements, you might think that the market is about to reverse. As a result, you may enter a trade against the trend during the pullback. But what happens next? The market resumes its upward movement, the next impulsive move begins, and you get stopped out. This is exactly why understanding market structure is so important. It helps you stay aligned with the dominant side of the market and avoid trading against it. Now the question is how to identify the beginning of an impulsive move and the end of a retracement. This is where support and resistance become extremely important, because they give us a clear reference point on the chart. If you want to understand this concept in more detail, you can check the previous lesson where I explained support and resistance step by step. But for now, let's focus on how to use them within market structure. Let's look at this chart example. As you can see, the market moves upward and then starts to reverse. This first movement to the upside is what we call the impulsive move, where buyers are pushing the price higher. After that, the market starts to move down, which is simply a retracement caused by profit taking, not a reversal. At this point, we identify an important area where the market previously reacted. This is where we place our resistance level, because this is the zone where price stopped going higher and reversed. This level is called resistance, because sellers were strong enough at this point to push the market down. Now look at what happens next. The market starts moving up again with strength, creating another impulsive move. But this time, something important happens. Price breaks above the resistance level. This is a key moment in market structure, because once resistance is broken, it does not remain resistance anymore. It turns into support. The reason behind this is simple. A level that previously stopped the price from going higher is now being accepted by the market as a new base. Buyers are now willing to enter at this level, which changes its role completely. Now, when the market starts to retrace again, it does not move randomly. Instead, it comes back toward this level that has now turned into support. This is where we shift our attention, because this level becomes a reference point to identify the end of the retracement. As price reaches this support level, we start looking for signs that buyers are stepping in again, and as you can see in this example, the market reacts at this level, gets rejected, and then starts moving upward again. This movement marks the beginning of the next impulsive move. So instead of entering randomly or chasing the market, you are now waiting for price to come back to a key level, and then you position yourself at the moment where the next move is likely to begin. At this stage, you already have 3 very important skills. You know how to identify an uptrend, you understand how the market moves within that trend through impulsive moves and retracements, and now you know how to use support and resistance to determine when to plan your trades. We will go deeper into this concept throughout the video and refine this approach even more. So make sure you keep watching and do not skip any part, because by the end of this lesson, you will be able to look at any chart and understand what the market is doing with clarity and confidence. Now let's move to the downtrend. A downtrend is simply the opposite of an uptrend. Instead of the market moving higher, it starts moving lower by forming a sequence of lower highs and lower lows. This structure clearly tells you that sellers are in control of the market. In this case, the psychology is reversed. Instead of buyers pushing the market up, sellers are the dominant force. They sell at higher prices and aim to buy back at lower prices, which is why the market keeps dropping over time. Just like in an uptrend, a downtrend does not move in a straight line. The market moves in a repetitive cycle. First, we have a strong move downward, where sellers push the price lower. This movement is called the impulsive move. It reflects strength from sellers as they are dominating buyers and driving the market down. After this impulsive move, the market does not continue falling immediately. Instead, it starts to move upwards slightly. This happens because some sellers begin to take profits, which causes a temporary rise in price. This upward movement is called a retracement or a pullback. So in a downtrend, the market is constantly alternating between these two phases, an impulsive move downward, followed by a retracement upward. Now the question is, how do we identify these phases and trade them correctly? Once again, we use support and resistance as our main tool. Let's look at this chart example. As you can see, the market moves downward, creating an impulsive move. Then it starts to retrace up.